Good afternoon, and thank you for joining us for this installment of Epic Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at Epic Retirement Plan Services, and I'll be your host for today's call. We're excited to be joined today by the one and only Ken Enteman from our NBT Wealth Management family to share a less than dry economic outlook during these tumultuous times. Ken is a Senior Vice President and Chief Investment Officer at NBT Wealth Management, where he brings to the table over 33 years of investment experience and oversees more than $6 billion in assets under management and administration in trust, custody, retirement, institutional, and individual accounts. Ken is a former board member of the New York Bankers Association and was the chair of the Trust and Investment Committee. He served on the board of the Central New York Community Foundation from 2006 to 2012, and he currently serves on the Roman Catholic Diocese of Syracuse's Investment Advisory Committee. He's also earned his CFA, or Chartered Financial Analyst designation. As always, your line will be muted throughout the call, but if you have any questions you'd like me to run by Ken at the conclusion of the presentation, please do enter those in the questions panel, and I'll be glad to throw those out there. With that, I'll turn it over to Ken.
Well, good afternoon, everybody. Thank you, Brian. Thank you, Chris, for organizing this and having me. I was looking through my notes, and the last time I had an opportunity to speak at the Epic Insight conference here was back in December, and boy, what a different world we live in today. Back then, we were talking about the strength of the economy, full employment, and how long the longest expansion in the United States history was going to run. We're kind of in a different place. We're in that different place largely because of the obvious, which is the COVID-19 virus. I'm not going to spend a whole lot of time because I think we're all pretty familiar with what's going on. These two charts, though, I do think tell an interesting tale. On the left is daily infection rates and mortality for the international marketplace, and on the right is the U.S. We know back in March and April, the world kind of came to a sudden stop due to the spike in coronavirus. In particular, the death rate was pretty high. But what you can see is that the death rate in particular, the yellowish line or orange line, seems to be behaving itself right now. But there are concerns. I think particularly in the last couple of weeks, there was a sense, particularly when the U.S., you could see that kind of spike in virus activity in the middle of the summer, particularly down in the south and southwestern states of the U.S. popped up. But there was some solace in the fact that the death rate, while it popped up, didn't go quite back to the levels of where it was back in the spring. And then when you look at the European side or the international side, you saw the death rate come down. Now, just recently, in the last 2 weeks, there's concern about the UK. Prime Minister Johnson talks about the UK being in a, quote, perilous turning point. And this week, today marked the third time in a week that France had over 13,000 infections reported. So infections are spiking up in Europe, in particular France and the UK. But again, and I'll talk a little bit about this in a little bit more detail when we talk about social policy in a couple of minutes. I think the encouraging thing so far is that the death rate has remained in a pretty low level in international and in a declining level here in the United States. But make no mistake, back in March and April, the COVID virus had a material impact of really historic proportions on the U.S. economy and the global economy. And this chart, I hope, puts some perspective on this to talk about just how severe was the economic contraction back in the spring. And first, to start on the bottom, the age of expansion. This chart came from our last presentation back on December 19th of last year. And we were talking about the bottom chart and how the 11-year expansion of the U.S. economy was the longest in history. And quite frankly, 2020, as bad of a year as it's been, started off gangbusters. The economy did incredibly well in January and February. We experienced that here in upstate New York and in the Northeast, where MBT is located primarily as a banking operation. And we were off to a great start. And then COVID hit. I gave a presentation, I think it was Wednesday, March 13th. And on March 15th, that Friday, the bank went 100% remote. And so really that mid-March period is really when the COVID impact started. And you can see it in the numbers. So when you go to the top chart, this is quarterly GDP numbers. You can see that first down blue bar, that's a minus 5% quarterly contraction. That's pretty remarkable when you think that January and February started well. So that 5% correction or contraction in GDP growth occurred almost entirely in the month of March and certainly carried through in the second quarter. So 5% contraction in GDP in the first quarter, followed by an epic, by far and away historic minus 31.7% decline in GDP in the second quarter of this year. That is by far and away the worst economic contraction we've experienced. And to put this in perspective, those of us who've been around long enough and remember the financial crisis in 2008, which is on the far right of this, the worst that we experienced was the fourth quarter of 2008, and that was a 9% GDP contraction. So when you think back to 2008, 2009, and think about how severe that financial crisis was and how big of an impact it had on the economy, it really does speak to the epic proportions of the contraction that the U.S. economy experienced. So, by definition, a recession is 2 consecutive quarters of negative GDP growth. We got that in the first and second quarter of this year. And generally, the economists, the National Bureau of Economic Research, who are the declarers of recession, haven't declared the recession over, but it does look like the recession is over in that the forecasts for third quarter GDP are somewhere, and they started around 20% growth. They're migrating up to 25. I saw one estimate of 35% today. So it appears that the recession came and went pretty suddenly. And you can see how severe, once again, the economy was impacted, particularly in the employment numbers. So this chart gives you unemployment. Last December, I shared with you this sign by my local home, Lowe's Home Improvement Store, where they were desperate to hire people. That sign went down, but to be honest with you, it's back up. And what you can see from this chart is unemployment spiked. It spiked to 14.4%. But then came down in July. This chart shows unemployment at 10.2, and currently it's at 8.4%. So we've seen a pretty material improvement in the employment numbers. And in fact, that unemployment, that help wanted sign for Lowe's is back up. And anecdotally, I'm starting to see quite a few of those. To kind of put a more finer print on this, when we look at initial jobless claims, so what is an initial jobless claim? That is when an individual goes into their local Department of Labor or the county clerk's office and files for unemployment insurance. And again, to put some historic perspective on this, March 27th of 2020, I'm talking about the line graph on the bottom, the weekly initial claims number was 6,867,000 people went into their local unemployment office and filed for claims. To put that in perspective, we talked about the 2008-2009 financial crisis, and some of the more gray-haired amongst us, including me, that remember 1982. The 1980 to 82 recession was also one of the worst recessions on record. And the previous worst weekly initial claim number occurred in these two periods. So the financial crisis of 08-09 and then the deep recession in 1982. And the world record number prior to March 27th was 695,000. So the number that we experienced in March of this year was quite literally 10 times greater than the worst case experience we ever experienced in the initial jobless claim numbers. So again, it kind of speaks to the magnitude of how severe this economic contraction was and how swift and sudden it was. When you look at the chart embedded, the total initial claims since March 14th, you can see that spike in the 6 million number, but you can also see the steady improvement in the number, whereas now we're hovering around 800,000 initial claims in the last 2 weeks. Hasn't improved much, so that improvement is slowing, but you can see that dramatic improvement. But again, it speaks to the historic proportions of just how bad this economic contraction was. Because we had such a severe contraction, it required kind of a pretty severe remedy. And as historic in proportion the contraction was, the response to this, both from a societal standpoint, a medical standpoint, and then specifically a monetary and fiscal policy standpoint, was equally unprecedented. So let's take a look at that. So I think one of the big risks, and we'll talk about risks when we close the presentation out, one of the biggest risks obviously is, what is the course of the COVID virus? Are we going to experience a second or third wave in the cold and flu season? As the weather turns, we get forced indoors. I fully expect that the number is going to pop up, but if you recall that first chart, we have experienced spikes in infection rates, but the number of hospitalizations and the number of deaths continue to kind of flatline. There's a local university up here in upstate New York, SUNY Oneonta. They had 730 cases on their campus when the kids returned to school. There were 0 hospitalizations and 0 deaths as a result of the virus. Now, that's obviously a young person population, but it speaks to just the social policy of washing hands and wearing masks and limiting large groups. I just think as a society, it took us a while to find religion in terms of combating this virus, but we're there. I think perhaps more importantly, our healthcare system in general is accelerating the way that we handle the virus. I think the spike in the number of cases is partially due that we're just testing more. And there's tests around. Abbott Labs has a $5 test. There's now a saliva test out there. So it's getting relatively easier to test, and the tests are getting better, and there's less false positives, less false negatives. So we're getting better at testing. I think we're getting better at treating the virus. I think that's why the death rate stops. One of the things that frustrates me about the political divisiveness of today's world is this virus is pretty novel, and it really has been a trial and error way of handling it. And blaming this governor or that president or this healthcare expert, I mean, to me is counterproductive. We really were trial and error. And I think you can think back to April and May when putting people on ventilators, and the big crisis was we had a shortage of ventilators. Kind of turns out that putting people on ventilators, unless they were severely, literally on death's bed, wasn't probably the right way to do it. And now we have improved our antivirals. Remdesivir from Gilead has proven very effective for those who are severely ill. Shortens the time frame that they're hospitalized and prevents death in a particularly material way. So we're better at just treating the virus. We've discovered that something when we talk about off-label use, it turns out that just using simple, low, really cheap steroids really helps combat this disease and has helped keep it down. And today, if you've been watching the news, Johnson & Johnson announced that they're starting phase 3 of their vaccine. There's been some pretty positive news from Moderna and AstraZeneca. Dr. Fauci was on just earlier today talking about approval timeframe of December, late 2020, early 2001 for a rollout of vaccine. The vaccine is the holy grail, but from my way of thinking, we're going to be living with this virus. We're going to be managing this virus for at least the next 6 months. If you're waiting for an all clear signal, I don't think that happens until we get widespread distribution and adoption of a vaccine. And I doubt that's going to occur before the first quarter. So we're going to be living with this. Can it get worse? Absolutely. One of the biggest risks in my mind is that you do have a spike in infection rates, the hospitalization and the death rates follow suit and spike, and then you have that the need for a forced lockdown. And I think that's the fear in the marketplace because of what's happening in the UK, where they're contemplating another lockdown. That is the risk. But when I look at the social response and the medical response to the virus, I think that generates some pretty good reason to be, or gives you good cause to be reasonably or cautiously optimistic about our ability to manage this virus. Remains to be seen, no certainty here, but I think we're getting our arms around how to manage this, and I'm encouraged by that. And from my perspective, I do not anticipate this worldwide lockdown reoccurring like we did back in April of last year. Let's turn our attention to how the financial markets, what did we do from a financial markets perspective? And when you put this in perspective, the US economy is more or less $20 trillion in size. It was a little bit more than that. We had a contraction, but let's call it, to make our math easy, $20 trillion. When you look at the monetary and physical response just here in the United States, it rounds out to be somewhere between $7 and $9 trillion of stimulus pumped into the economy in a very short period of time. That is unprecedented and of just incredible magnitude. And quite frankly, it appears to have worked. This chart here talks about monetary policy. So here we're talking about the Federal Reserve. The Federal Reserve is all in. Just recently this week, Chairman Powell gave a speech that basically said that the Fed is in it for, quote, for as long as it takes. What did the Fed do? Well, we all know they cut interest rates to effectively zero, immediately injected $1.5 trillion into the U.S. bank system, kind of turned on the quantitative easing, which they were trying to pull back away from. But not only did they turn it on, they did something different this time, different from what they did in 2008, 2009. And what they did differently is they moved into commercial or corporate markets. So historically, when the Fed did quantitative easing, what does that mean? They're buying treasury bonds, they're buying mortgage-backed securities, government-guaranteed securities. Why? Because they're buying securities, that drives the price up. And we all know fixed income interest rates in fixed income world, when prices go up, interest rates go down. So they're suppressing interest rates, providing that stimulation. Because of the severity and the swiftness of the correction that we experienced back in March and April, one of the scary experiences of my 35-year career, there were clearly markets that were seizing up. The commercial paper market was seizing up. The high yield bond market was seizing up. Spreads in high grade investment corporate bonds were seizing up. Municipality muni bonds were seizing up. And the big difference, I would say, about monetary response this time, as opposed to just cutting interest rates, was that quantitative easing extended out into the corporate world, and it had a dramatic effect on the liquidity of the marketplace, and really prevented which was a really stressed out fixed income market, and put it at ease. So you saw this massive spike in spreads. So high yield bonds, that spread widened out from about 400 over treasuries, went over 1,000 basis points over treasuries. And today it's pretty much right where it was pre-COVID. Pretty remarkable, highly effective monetary policy. All told, when you add this all up, somewhere between $3 and $4 trillion. Let's move our way down the street in Washington, D.C., and go over to Congress and the White House and talk about the fiscal response. Again, when we add this up, back of the envelope, $3 or $4 billion worth of activity. This chart kind of lists a lot of the things that were done. I would summarize what the two most important things as extended and enhanced unemployment benefits. So anybody who's unemployed, not only did they get the duration of their unemployment extended, but they provided a $600 enhancement to that unemployment benefit. So, and the way it worked out, a lot of politics going on here, but the vast majority of people who were collecting unemployment were actually paid more in unemployment than they were when they were working. And that created some incentive issues for the recovery. But the point is, unemployed people were kind of made whole, and it carried us through the worst of the crisis. The problem we have is that unemployment benefit expired on August 31st, and we're currently fighting it. The second big piece of this was the PPP loans. So these were loans that banks like MBT and local banks provided to local small businesses. So the Fed kind of took care of Wall Street. The PPP program was designed to take care of Main Street. So your local restaurant, your local electric contractor, your local business owner, those are loans that were provided to those smaller businesses. Very powerful. Stimulus to the economy, allowing those companies to maintain their payrolls, keep fewer people on unemployment. It worked pretty well. The vast majority of those loans we expect to convert over to grants so that the businesses won't have to pay for it. And the combination of those two things, the extended unemployment benefits and the PPP loans, basically carried the day from April through May, June, July. Then we got to late summer, August, and that's when those things expired. And that's where you're hearing a lot of the debate on today's political thing, is whether we're going to get another stimulus. It is mired in the politics of Washington. I don't think the passing of Ruth Bader Ginsburg and bringing the Supreme Court into the fray helps matters. The Democrats want to issue a $3 to $4 trillion bill. The Republicans were at a trillion. They tried to pass a $300 billion skinny bill. That didn't pass. Now that they've signaled they're willing to do $1.5 billion, there's just a big question mark whether they're going to be able to come to agreement prior to the election. And what I think you can see in the numbers is that things were going pretty well, and now they're starting to slow. So when you look at historically, epic meltdown of the economy, swift, sudden, severe in March and April of last year, deepest economic contraction, but counterbalanced by really the biggest financial stimulus we've ever seen. And I'm talking specifically here about what the US government did. You can really go around the world because everybody was doing more or less similar things. So you had this massive response to this massive contraction. And I would argue it worked. When I look at this chart, if we had this discussion in July, we would, the hot debate was what kind of a recovery were we having? Was it V-shaped, L-shaped, W-shaped, U-shaped? And I think these charts here give you a sense of a V-shaped recovery. So when you look at the top left, manufacturing, industrial production, sharp snapback in activity that frankly continues today. Retail sales higher in August than they were pre-COVID. Pretty remarkable. Now there's a lot of winners and losers in those numbers. Amazon is one, Home Depot, Lowe's is one, JCPenney's, Macy's, Lord & Taylor, Nordstrom clearly have lost. But nonetheless, the consumer was, in fact, spending money in that summer. We've already talked about the employment numbers, but if you invert that chart, certainly looks like a V shape. And then when we look at more high frequency data like lumber prices, steel, coal, electricity output, clearly shows a very sharp snapback in economic activity. So I would say through August, we were if not in a V-shaped recovery, in a pretty strong economic recovery. Since then, as I mentioned, the unemployment benefit, that enhanced benefit, is rolled over. The PPP loan, while there is still money available in it, it hasn't been re-upped. And that, I think, has sent the market the economy into a little bit more cautious stance. So we mentioned initial claims. They were steadily and improving. In the last 2 or 3 weeks, they've kind of stabilized around 800,000 initial claims a week. And again, put that in perspective, that's a lot better than 6.8 million, but it's still 800,000 compared to the 695 worst case scenario we ever experienced before. But so you've seen that rate of improvement slow a little bit in employment. Retail sales while still growing, the rate of growth slowed. We've seen slowdowns in the rate of credit card activity, restaurant reservation activity, TSA, the number of people going through checkpoints at airports, i.e. airport airline travel. All of that is slowed in the month of September. And it's kind of hard not to kind of at least partially explain that by the lack of unemployment benefits. And of course, you got the election coming up, which creates a whole lot of noise too. So I think we're in a position where we had this horrible contraction in the economy, massive response that kept the plumbing working, kept the economy flowing, and now we're in a point where we're worried about COVID, we're worried about the election. The fiscal stimulus is wearing off a little bit, and I think the market is trying to feel its way out of where we are right now. And I think that's going to generate volatility, like we see today with with the markets down 2.5% today. I think you're going to continue to see that. So how have the markets behaved? Lots of volatility, but quite frankly, through the end of August, things look pretty good. The financial markets, the equity market measured by the S&P 500 up 9.74%. And if you think of your classic 60-40 balanced portfolio, Barclays aggregate bond index up 685. Not bad for your plain vanilla 60-40 portfolio. So the markets have recovered. It is truly the most volatile period I've ever experienced. Back in March and April, this to me is pretty astonishing, particularly with the benefit of hindsight. But we experienced the fastest bear market in the history of the world. So a bear market is 20% decline from the peak of the S&P 500 index. And we went from peak to down 20%, the definition of a bear market, in 38 days. And we proceeded to go past that 20%, and the peak to trough, March to April, February to April, total peak to trough decline was 34%. Remarkable. Not that 34%, quite frankly, is the average decline when you have a deep economic recession historically. So that number in and of itself is kind of mundane or average. But the fact that it all happened in a 30 to 50 day window is really quite remarkable. But equally remarkable is we also experienced the fastest bull market in history. So a bull market is a 20% increase from the bottom of the market. And that happened in a, quite again, remarkable 3 days. And since then, through August, with the S&P 500 from its trough in late March to its peak in early September was up about 60%. And right now, today, we're probably up a little bit over 50% from the bottom. So the market has recovered remarkably. I would argue a whole lot of that has to do with the massive stimulus and the massive amount of liquidity that the Fed has pumped into the economy, that the fiscal stimulus from the fiscal policy has pumped in, and you're seeing that come through. So I think the markets have kind of held their own. But I also think there's some risk out there that we need to be aware of. And I think that they're all going to be prominent, particularly over the next 2 or 3 months. And I think they will lead to a great deal of volatility, not necessarily a major correction, although I think that can happen it can always happen anytime. But let's talk about this. And part of it starts on this page. When you look at the S&P 500 growth number up 26%, and the S&P 500 value number down 9%. That differential of, call it 35% difference between growth performance and value is historic in proportion. It's never been, that differential has never been that great. So the growth market has been on fire, the value market has not. You can see it in this chart, and one of the concerns is you have all this investment concentrated in just 5 stocks. Apple, Amazon, Microsoft, Alphabet, Facebook, those top 5 stocks constitute nearly 25% of the S&P 500, and the top 20 firms represent about 45% of the S&P 500. And history tells us when these numbers get this high, and basically the last time we experienced this was in the late 90s, and the time before that we experienced it was 1973 with the Nifty 50 stocks. And history isn't kind to this kind of market concentration. And I would argue that what we started to see in September was people coming to the realization that as good as these companies are and as promising as their products are, their valuations are kind of building in a whole lot of perfection. And we started to see a rotation out of these tech stocks, overvalued stocks, into that value universe. And I would call those the market recovery, economic recovery stocks. So all of a sudden, Caterpillar Tractor, Disney, airline stocks, cruise stocks, hotel stocks all started catching a bid because we were moving along nicely towards a reopening with the virus being under control. I think now in the last week or so, we've seen a lot of pressure on the markets, and it's not so much a rotation out of growth into value, but it's really more of a broader based correction in the marketplace. And I think that's because the COVID numbers are spiking up. And that's why I'm so concerned about COVID, one, but I'm also concerned about this market concentration. And I think the valuation question was really brought to stark contrast this last week when Snowflake, a cloud computing company, came public at $120 a share and almost immediately traded at $330 and finished the day at $230. The stock trades at 100 times sales, has no prospect of making money anytime soon. It sounds like a really cool company, but the valuations just got really extreme. And I think that's broadly affecting the rest of the market. And I think a good reason why you're seeing the market down quite a bit today, down 2.5% today, and it's just been a carryover for the month of September. What else do I worry about? I worry about China tensions. Last year we spent the bulk of the year, and a good part of my presentation to you last December was talking about the China trade deal. Turns out China has started to hold their promise, but they're not even close, as this chart says. But obviously you got the TikTok news, that acquisition, merger, forced acquisition, call it what you want, creating tensions. Hong Kong, Taiwan, South China Sea, India, China, Himalaya skirmishes. China tensions, I think, are not receiving the attention they should, but something that's liable to create some volatility going forward and be problematic or a risk that we need to contend with. The next thing I want to talk about is we talked about how great, and I give the Fed really good grades, A+ for all their satisfying of the financial markets and smoothing out of the volatility that we were experiencing back in the fall. But their balance sheet is heading towards $10 trillion. And when you look at the debt of the United States, that is expanding to the point where we're starting to approach World War II levels. So that's problematic. And when you look at the expansion of central bank balance sheets relative to what we've done in prior crises, of the chart on the right, you look at what we did in World War II, where we were building planes and tanks and bombs and all kinds of military equipment, boats and ships, and so that's kind of the world record. The U.S. Great Depression is the other green dot, but look at what we've done financially relative to the Great Financial Crisis, the GFCs. So you look at all the different central banks, and you look at what we've done for the Great Virus Crisis, the GVC, and boy, we've spent an awful lot of money. And the question that I have, not as a clear and present danger, but sooner or later we got to pay for this stuff. And historically, the way you do it is you do one of four things or a combination of these four things. So one, you raise taxes to cover the spending. Certainly this election is going to be about tax policy. I'll talk a little bit more about that in a second. But you can raise taxes, but raising taxes isn't going to get us there. On the top right, you can cut spending. In World War II, it was great because the war ended and we didn't have to build planes and trains and automobiles and tanks and bullets and all of that. So we just stopped spending on that, and spending curtailed it. The benefit of the World War II spending, the debt was really paid off by a remarkable growth spurt in the 1960s, where the economy grew on average around 5%. I don't know that that's going to happen. Our economy is much larger today, and B, we've already struggled to get from 2 to 3% growth, and now we're back to negative growth. So that's a tall order. And the last way is to generate inflation, which has happened in the past. The Fed has certainly said they will lighten up on inflation constraints. that's good. But when you look at all four of these, it doesn't give me a whole lot of optimism that we're going to get our deficits and debt levels under control. And sooner or later, that could be problematic, particularly as it relates to inflation. So I think that's something to keep an eye on. And then I don't know if anybody, those of you out there are aware of this, but it is an election season. You might want to turn your news on. You might see an ad or two or a sign. But this election was Donald Trump's back in May. Then COVID hit, and we had the social unrest of the summer. And the polls kind of reversed, and you can see how they're coming back tight. This is a real clear politics, showing a pretty tight race. I saw a poll yesterday that had the difference at, say, 8 points in favor of Biden. Right now, Biden is leading in most polls that I see, but it's pretty close. And I would refresh your memory that Trump was trailing in all the polls in 2016. When we look at the financial impact, financial market impact, I think the two Royal RBC did a survey, and the one thing I would caution you is the president, who owns the White House, what party's in the White House, historically is not terribly statistically significant in terms of better returns or worse returns. The general consensus of surveys of Wall Street strategists is that a Biden victory would be either neutral or bearish. That I don't think is the issue. The issue is, what if the Democrats sweep everything? Meaning the Democrats win the House, they win the Senate, and they win the White House. I don't think the numbers in the House, it's kind of hard to suggest that the Republicans have a shot at turning the House or flipping the House. Obviously, the Senate's going to be hotly contested, and then the White House is going to be contested. But look what happens to the survey when you say the Democrats sweep and control all three. The market becomes much more bearish. And I think this will generate a whole lot of volatility as the election season, with 41 days to go. You're going to get all kinds of headlines, both good, bad, both for Warren, Trump, Biden, back and forth. But I think the consensus is that, and I am not trying to be political here, but when you look at what the tax plan of the Democrat policy is, and especially you look at those top two, the taxes on capital gains as income, that's a doubling of the capital gains rate. That's not a good thing for stocks. The increase in corporate tax rate from roughly 21 to 28%, those are pretty big hits to corporate earnings and stock prices that I do think will have a negative impact in the near term if in fact you do it. And you can see a whole other host of, the 10% corporate minimum tax. You might as well call that the Amazon tax, because Amazon invests so much money that they never show a profit, so they don't pay taxes, but they're still, rolling in trillions of dollars. So that 10% tax you could call the Amazon tax. But you can see that, and when you wrap that all up, it's $3.4 trillion of taxes. That would put a dent in stock market activity, and I think that's something that will generate a whole lot of volatility in the next couple of weeks. So let's wrap all this up. Coronavirus, it's still uncertain. I am cautiously optimistic that through trial and error, some of those errors tragic, but through trial and error, we're getting better at it. We're becoming more compliant as a society in terms of mask wearing and hand washing and not going into crowded movie theaters, so to speak. But the depth and duration of it is still uncertain. And I certainly, as I said earlier, think we're going to live with this for the next 6 months at least, even if we get a vaccine. So if you're waiting for the all clear signal, I don't think it's going to happen anytime soon. That coronavirus impact was historic in proportions, but the massive global monetary and fiscal response was equally so. I think it means interest rates are likely to remain rock bottom at low levels for a long, long period of time. I think that has interesting ramifications for investors, and in particular 401k participants. When they look at their fixed income holdings, you're not going to get a whole lot of income out of those holdings. Because of the uncertainty of the coronavirus, the sustainability of the stimulus, the potential impact of tax policy, corporate earnings are really a wild card. They were rebounding nicely, forecasted to be up around 6% in the third quarter. The question is, where are we going forward? And just to wrap up the risks, I do think the end all be all is the virus resurgence. Again, hopefully we're able to manage that, but I think you're foolish not to expect virus cases to increase in the cold and flu season. The question is, can we manage that? And my vote is that we will be able to. We'll see. Reemergence of China, I think this is a longer term problem. I think it would be top of the news headlines if it was normal, but coronavirus doing. Equity market concentration, we're kind of going through a correction, which I think is healthy. And I think the election season is going to generate a lot of volatility. So I would say for the next 41 days to 60 days, fasten your seatbelts. It's going to be a rocky ride. So that's my whirlwind tour of the world. I hope, Brian, that was sufficient for what your needs are. And if there's questions, I'd be happy to take them.
Yeah, appreciate it, Ken. I'm buckling up for that rocky ride. I'll just put my head in the sand and hope for the best on the other end.
There you go. Not a bad plan.
It doesn't look like any. Yeah, go ahead.
It would have. No, that's not a bad plan because if you didn't do anything in April, you wound up doing okay.
I'm gonna stick with that. Ignorance is bliss right now. Doesn't look like we have any specific questions, and I know we're a little over time, but I'll remind everyone we will send out a recording and a copy of the slides from today if you want to take a look at that. Thanks again to Ken and the NBT Wealth Management team. Thank you all, of course, for joining us. We truly appreciate your partnerships and wish you and your families well. Take care.